So what are futures contracts? Well, you've probably bought a stock before, or at least you've heard of it. You'll find a company you believe in, you buy a share, and you wait for it to hopefully go up. Simple enough. What if I told you there's an entirely different market? One that's bigger, faster, more tax efficient, and honestly far better suited for algorithmic trading. And it's one that most retail traders haven't really ever heard of, or at least don't have a lot of experience in. And this market, well, it's the futures market. And once you understand how it works, you'll understand and wonder, why isn't everyone using it? Well, here's a simple way to think about futures and what actually they are or what they're doing. Imagine you're a farmer, it's March, and you know you'll have 10,000 bushels of wheat ready in August. But you're worried the price might drop by then. So you make a deal today, a contract with a buyer who agrees to purchase your wheat in August at this price. That's a futures contract. It's a legally binding agreement to buy or sell something at a set price on a set date in the future. Now, you're not actually farming anything here, but that concept is the same. You're locking in a price for a future transaction on an underlying asset. And this is what futures traders do every day with stock, indices, oil, gold, currencies, and more. But who actually trades futures? Well, the biggest players are, you guessed it, institutions. Banks, hedge funds, commodity producers, airlines hedging fuel costs. But the futures market is also wide open to individual traders and algorithmic systems. In fact, it's one of the most popular markets for professional day traders in the world, and for good reason. Now, one thing that often surprises people, the futures market is one of the most regulated markets on the planet. In the United States, futures trading is regulated by the CFTC, which is the Commodity Futures Trading Commission, and it's also overseen by the NFA, which is the National Futures Association. Every broker, every platform, every participant operates under strict federal oversight. This is very different from forex trading, which is largely decentralized, unregulated in many parts of the world, and has far less investor protection. When you trade futures, you're operating inside a highly structured, transparent, government-regulated framework. So what exactly is a futures contract? Well, each futures contract represents a standardized amount of an underlying asset. For example, let's talk about ES. One ES contract, which is the E-mini S&P 500, represents the equivalent of $50 times the S&P 500 index. One NQ contract tracks the NASDAQ 100. You don't need to buy the full value of what the contract represents. You put up a fraction of that value, called margin, to control the contract. That's what gives futures their leverage, and that's what makes them efficient for trading algorithms. Now, is this a 24-hour market? Almost. The major futures markets trade nearly 24 hours a day, 5 days a week. The ES and the NQ, which are the S&P and NASDAQ futures, are open from Sunday evening through Friday afternoon with only a daily brief break. Compare that to the stock market, which is open for just 6.5 hours a day. Futures gives you access to react to the global news events, earnings releases, and economic data in real time, not when the markets finally open up the next morning. Let's talk about why futures are so uniquely powerful for trading algorithms. First and foremost, liquidity. The S&P 500 futures market trades hundreds of billions of dollars in volume every single day. That means your orders get filled instantly at the price you expect without moving the market. Second, you can profit in both directions. In the stock market, shorting is very complicated. It requires borrowing shares, paying fees, and dealing with restrictions. In futures, going long or short is very simple. Our algorithms take advantage of both directions every single day. Third, tax efficiency. In the US, futures contracts held for any period of time are taxed under what's called the 60-40 rule. 60% of gains are treated as long-term, 40% as short-term, regardless of how long the position was held. So compare that to stocks where you need to hold for over a year to get long-term capital gains treatment. And fourth, low costs. Futures have tight bid-ask spreads and low commission relative to their notional value. For an algorithm making dozens of trades in a month, that efficiency compounds significantly over time. Now, futures versus stocks, what's the real difference? Well, with stocks, you're betting on one company, one earnings report, one CEO scandal, one product failure, one bad demo video, and your position can collapse overnight. Futures, especially index futures like S&P 500, NASDAQ, or even commodities futures, well, they're tied to the performance of a lot of things, like indexes are tied to hundreds of companies. So it's far more diversified, far more predictable in behavior, and much better suited to rules-based algorithmic trading. This is why every one of our algorithms at Vincere trades on the futures market. We need a market that's open nearly around the clock, that is also deeply liquid, regulated, and moves with enough consistency that a rules-based system can actually find repeatable edges. Futures checks every single one of those boxes. And what about getting your money out? This is always a big fear that a lot of people have, particularly with like hedge funds and institutions. One of the biggest advantages of futures over something like real estate, private equity, or even some hedge funds, your capital lives in your own brokerage account. You control it. When you want to stop trading, you stop. When you want to withdraw, you withdraw. Settlements typically happen within one business day. So there's no lockup periods, no redemption windows, no fund manager standing between you and your money. Now, the futures market is one of the most large and liquid and most accessible financial markets on the planet. And most retail traders have never really even touched it. And that's the opportunity. So if you're curious about how our algorithms actually trade within this market, then definitely look through the other videos on this page. And if you really want to talk with one of our team, schedule the demo with the demo link somewhere on this page, and they'll be able to answer any questions that you possibly couldn't get answered with all the videos and information we have on this page. So please, I highly encourage you to take a look at everything you see on this site and then schedule a demo call. Do some of your own research on futures and why it's a great market for algorithmic trading. Check out the numbers and the performance that we have, and we'd love to have you come on as one of our next successful clients here at Vincere Trading.